Good evening, ladies and gentlemen. Welcome. I'm your host, Dan Theok, Senior Vice President of Investment Banking. Welcome back to yet another investor briefing where we'll be looking at NCB's Q2 results today. On the panel, we're joined by Rob Amelia, CEO of NCB Financial Group. Welcome, Rob.
Thank you.
And once again, we're joined by Angus Young, CEO of NCB Capital Markets. Great to have you guys back again. Felt like you were just here the other day. Well, if you guys watched the program last week, you would have heard the great news about the APO, and now we're back to share the Q2 results. Additionally, if you're a fan of the content, then don't forget to subscribe to our YouTube channel. Hit the bell to stay up to date with the channel as we upload content just like this just about every week. Additionally, if you want to embark on your very first investment journey, take that first step with Mayberry, of course. Follow us on social media to learn about how you can get started today. Okay, guys, we talked about it last week. I was waiting with bated breath. I've seen the results. I think I was right, but Rob, why don't you take us through them?
Okay, thanks, Dan. Yeah, your point on being right, I think, is the key point. But it's the rationale on your expectation. Your expectation was, and I think quite rightly so, your expectation was that we should be about a $5 billion a quarter business as a minimum, just as a straight base. And the quarter should have been we did the reset. And the quarter should have been the first clean quarter that gets us to, that says, here's the new base.
Absolutely.
And so I think all of that logic was spot on when you talked about it last week. I obviously couldn't say anything about that logic, but it is true. It was true, and it is true. So in the quarter, we delivered a quarterly profit of $5.6 billion attributable to shareholders, so net of minority interest. We realized $7.7 billion of consolidated profit. The key thing is that that number is up 75% year over year. So the 5.6 billion versus 3.2 billion in the prior quarter. Now, the other key number to look at in the quarter is our cost to income ratio. So if I'd ask you to look at three different numbers in the quarter. One is our operating income year over year went up about 6%. And the other is our cost to income ratio went down about 7%. So what you're seeing happen in the quarter is that prior to the quarter, we did the reset at the end of last year. So we took out about $8 billion of expenses. Then in the quarter, what you're starting to see is the operating income, the normal operating income growth in our business come in there at about 6% while we held the expense line flat. And as we did that, what you see the cost to income ratio drop from 74% to 67% year over year. And then that operating leverage kicks in where the impact on profitability, instead of at 74%, it meant 26% was going to profit. At 67%, 33% goes to profit. So we grow by a bigger portion. The profit increase is much bigger than the reduction in the cost to income ratio. And so you have profit increase 75% year over year. The other thing, Dan, I'll tell you is that the other thing to pay attention to is within there, our banking and investment revenues were basically flat year over year. But on the insurance side, that's where we had growth. And that's a function of the liquidity conditions, and the high interest rate environment continues to exist. So we don't have the banking part of the business kicking into gear yet. What we've got is the insurance part starting to grow from having done the changes that have gone on in that business. And the combination of all of that sets this new platform of around $5 billion a quarter, and we're looking to grow from there. So Dan, just to recap, what have we done over the last 6 months? We did the reset on expenses. We increased our efficiency. We've reallocated a bunch of capital so far, and we've got more activities going on, and we resumed the dividend payments. And so that's the progress we've made, and all of that is part of what we're saying is it's reset the base. And so coming out of this quarter, we're expecting that this is the platform that's established us to be poised for growth. And maybe what I'll do is I'll just actually ask Angus to talk a little bit about how that growth platform kicks in on top of this new base.
Sure, thanks, Rob. So there are two waves of growth that we see going forward. The first one is one where we rise with the tide. So Rob would have spoken before. If you look at what's happening in New Kingston, in Mobe, Ocho Rios, St. Thomas, it's obvious that the Jamaican economy is going in a positive trajectory. It's obvious that the Jamaican debt to GDP is heading south. So the macroeconomics are constantly improving. Jamaica is constantly being upgraded by the international credit rating agencies. So given that NCB is so systemically significant and important, one could conclude that NCB will rise with the tide of Jamaica. That's the first growth phase in terms of what we expect from NCB. But the second phase, which is happening simultaneously, which we're now delving into, really has to do with the way NCB behaves internally. I would have mentioned last week that the different divisions within the NCBJ banking group historically, unfortunately, would have operated very much in silos, right? So you have NCB Capital Markets, you have the corporate bank, you have payments, everyone chasing their own targets, doing well on their own, not doing well in terms of talking with each other. So when you think about an institution that has the greatest share of primary customer relationships in a market as large as Jamaica, and when you think about not leveraging that and having the different divisions with NCB work together with a common goal, there is value to be unleashed. And that share of wallet approach is something that we're being very deliberate on going forward and restructuring ourselves so that culturally we align that way and view it as one P&L, so to speak, done.
Right.
So just that change in culture and change in approach in terms of leveraging the breadth of the bank and having that sort of cohesion between different divisions would unlock some value. Then you talk about NCBFG has operated primarily as a holdco in the last couple of years, meaning we own 100% of NCBJ and we own circa 62% of GHL, but the two institutions pretty much operate independently. And I think what you're going to see is a lot of deliberate strategy in terms of having those two ecosystems interact to extract value, synergistic value both on the revenue line and on the expense line. And that really focuses on things like centers of excellence, pillars of expertise, and scaling those throughout this ecosystem that is NCBFG. Now, we would have also mentioned, Dan, that we're of the opinion that perhaps in the wealth management and the pension plan space, it's underpenetrated, right? So we have not seen tremendous amount of growth in those two spaces in the last couple of years, but yet we have these awesome platforms that deliver service to that space. So you're going to see the group, again, be very, very deliberate in how we grow those spaces just by the focus on it, and it also acts as a differentiator because banking products are, in a lot of instances, commodities, right? And Rob would speak about becoming the lowest cost producer, right? And that way you could gain a competitive advantage. But what really differentiates NCB in this instance, or what would help lift that differentiation, is our focus on wealth management and the pension plan space, which is really grounded in the fundamentals of how do we make our clients more wealthy. I think that is also a large space where you'd see contributing to the second wave of growth. So I think there are two waves. One is more generic, we rise with the tide, and when you're an FI, typically there's a multiplier effect where that's concerned. And then the second wave, which can happen simultaneously, is that synergistic behavior within NCBJ Banking Group and within NCB Financial Group. And though we're being very, very deliberate in those spaces.
Great. Sounds good. Well, I certainly am impressed. And again, great to see you guys hitting that number. And I fully appreciate the further growth to come. It's a given that you can't outperform the economy. And it's also a given that the economy is poised for substantial growth, as you highlighted. And so I'm excited about that. And then there's just no disputing the strength of your balance sheet. I mean, both the deposits you have on balance sheet, over $600 billion, the assets you have under management, and the brand, the size of the business. So I really do think I would not want to be in a fight against NCB. That's why we like collaborating with you guys, because the strength of your balance sheet is just unrivaled in the region. Well, you guys talked about the quarter. I'd like to look at the half year very quickly. Again, just more of the same. Obviously, the quarter is demonstrating how strong the business is bouncing back, having taken out $8 billion of costs, like you said, in your year end, and now we're getting a first glimpse of seeing that efficiency improvement. So, as you said, for the half year, net interest income was relatively flat, only grew by 1%, $23.7 billion. But we see where you're reducing costs, and net debt. We see where your net results from insurance that also grew. Rob, you spoke about that by 51% to $25.2 billion for the half year. We see where your profit before taxation therefore grows by 72% for the half year to $17.5 billion, with the net profit attributable to shareholders after tax being $8.6 billion for the half year. So much stronger in the quarter, $5 billion for the quarter, $3.6 billion obviously in the quarter before, which gives us the $8.6 billion of combined results. So that improves your trailing earnings to $11.6 billion, and the PE ratio is now down to 13.9 at $63. But I think what really catches my eye is the EPS for the quarter alone was $2.34. So I expect your run rate after 4 quarters to be about $10 of EPS, which, folks, means at a $10 PE, it's a $100 stock. At a 12 times PE, as the interest rates come down in the next 12 months, it's a $120 stock. So that's my simple view of how I feel about NCB and where I think the stock price should be in the next 12 months, folks. If it's not at $120, something's wrong in my opinion. Interest rates are going to come down in the next 6, 9, 12 months for sure. The Jamaican economy continues to grow, reducing debt to GDP, among other things, bringing inflation under control, and the banking sector cannot outperform the economy. That's a given. So this is the sector and space that you want to focus on, and why not focus on the biggest and the best? Next slide shows the quarterly performance, just like we said, $3 billion 1 quarter ago, $5.5 billion this quarter. You can see in the year end with that $2 billion loss, it was a result of taking $8 billion in one-off adjustments, which was like $6 billion after tax. So again, when you back out that $6 billion after tax, you would have seen that they would have done $4 billion on an adjusted basis. So it's a business that's going to consistently, in my opinion, do $5 billion a quarter. And as interest rates come down and as the economy grows, it's going to get even better, folks. So this is definitely a stock that you want to go after. Next slide shows what's happened
Dan,
with
can
the
I
stock.
just
Sure, of course,
interject for a second? There's something I omitted to mention. Look at these numbers, which I think, don't listen it from me. Read the math, right? It validates the strategy, right?
Yeah.
But think about this. If we're delivering these numbers in this interest rate and liquidity environment, and then think about the probability of directional change where that's concerned, right? So think about, will interest rates go up or would they go down? What's the probability of each? If we can deliver these numbers in this environment, in this, what we now call steady state, in my humble opinion, with interest rates expected to go down at some point in time, it's going to positively affect our performance. So this steady state is in a high interest rate, low liquidity environment. Yeah. So there's upside to be had with a directional move in interest rates.
Yeah, no, I agree. And using kind of like boating terminology, if you're moving at this pace in the chop, when the seas settle, I expect that you'll pick up a lot more pace. So
Dan, you've used an analogy of a boat, right? But in my Chinese culture, the best boat is your friend's boat. So I don't know much about boats.
Yes, I appreciate you. And that's why I buy the stock. I leave you guys to run the business. I'm going to buy the stock. And folks, we're going to come back in a year's time. You guys are going to say, Dan, you are spot on. Stock's now at $120. Again, on the previous slide, I do want to make the point that when the tide was lower and the winds were slower, there were quarters that they delivered $7, $8 billion per quarter. So that's not unforeseeable in the future. Again, as interest rates come down, people will be more inclined to borrow. We're going to see much more IPOs and APOs. The stock market's going to come alive again, folks. We know that PE ratios are generally inversely proportionate to interest rates. So as interest rates come down, PEs are going to go up naturally. Plus, this business will be more profitable in a low interest rate environment. So when you think about it net, we've got the wind behind the sails, we've got the seas settling down, and we've got an engine that's more refined. So it just means more speed, better profits in the future. And that's pretty clear to me, even without looking at the stock price, again, this is a stock price that, and this is just looking at the last year. If we were to go back 5 years, I bought this stock 6 years ago at $90 and I loved it. And it went to $150. It stayed there for 3 years strong. You know, it touched 200 for a tad bit, but it demonstrated really good trading liquidity at $150. And, you know, I think it's just a matter of time before we get back there, perhaps 2 years. But for sure, in the next 12 months, folks, I think this is a stock price that can be at between $100 to $120. And we're going to just keep watching the results quarter by quarter by quarter. But if you wait till 3 months' time or 6 months' time to try to buy the stock, it may already be at $80 or $90. So now's the time to get it. Their APO is still open. You can still get some at $65 on the main through the APO, especially if you're trying to buy volume. Results just came out. So I think the stock price is actually going to jump past 65 in the next week or so. So APO is still a good option for you guys, and it's a way of putting income into the business to help grow it further. So that's another reason why large institutional investors should buy the stock. So a few questions I need to ask them. First one, Rob, obviously will be for you. What has sparked this quick uptick in performance in the group? I mean, we talked about efficiency, and I think it's kind of obvious, but I just want to give you a chance to address that question specifically.
So Dan, so fundamentally, it's that combination of the expense reset, the expense reduction that took place,
Right.
combined with more normal operating income growth. So nothing special on the operating income side, on the revenue side, nothing special on the revenue side, but the expense reduction with normal revenue growth kicking in, and kicking in off of that 80% cost to income ratio. So you mentioned what created the sharp uptick. And what creates the sharp uptick is we were starting from a 20% profit margin, and we take off the expenses, and we drop from 80 to 66. But we actually, year over year, we went from 73 to 67. But when you look at that, what you get is initially you get a much bigger, it's just a lower denominator,
Right.
Smaller denominator. So you get the smaller denominator effect. So that creates the very sharp uptick. That the growth continues thereafter, but the steepness of that growth curve slows down. And I think that's the sharp uptick is a function of all the reset things kicking in, and just normal, without us even kicking in on the revenue side growth. The revenue side growth is still to come.
Okay, I look forward to it. And Angus, how has the market received your APO so far?
Yeah, so far so good, Dan. We have 7 selling agents. So first of all, we invited all brokers to be selling agents, given the mission of having a broader investor base. Right. So we have 7 selling agents at this point in time. I expect 3 major firms to sign on in the coming days. So to date, we have Mayberry, right, of course, Scotia, JN, Barita, VM, QMax, and JMMB. Mm-hmm. What I would also say, Dan, that is noteworthy is pay attention to the Q in the NCB FG stock Q. That is also telling. And also, we have about 6 valuations that came out of those brokers who've signed on in the last week or so that place the immediate intrinsic value of the NCB FG stock between the mid to high 70s. Okay. So, you know, the tailwinds are there, and of course the interest is building nicely.
Good, sounds good. I mean, I obviously, folks, think it's worth much more because, again, you're just going to see the quarters keep coming, and then profit's going to keep jumping, and I think, you know, it's a $90 stock easy. So again, if you can get it at 65, I think you're getting a deal. Rob, what is the group doing to manage and maintain its non-performing loan ratio? So you're growing your balance sheet. You've got the largest loan book in town. How are you managing that?
So in the quarter, while NPLs in absolute dollars went up, the NPL ratio didn't change. So we're basically maintaining loan quality right now, and we're monitoring it because we continue to be in this high interest rate environment, and you have more loans coming off of their original fixed rates, and they're resetting at higher rates. So we're monitoring the stress that is potentially in the system, but our results so far, and as we look into the book, we're not seeing any signs of. This is not to say that there isn't stress and pain and anxiety out there in the marketplace with our customers. So I don't want to belittle that. It's a challenging time if you're a borrower. But at the same time, we're not seeing that stress play through into the into the loan performance metrics. And so our delinquency stats and our non-performing loan stats are all kind of holding where they are. But we monitor it very carefully. We're very vigilant on that, just given the tightness of the liquidity in the market and the high interest rate environment. But the main point is we're not seeing any deterioration.
Okay. Sounds good. And you've got about 7 business segments, I read, and 4 of them seem to be improving. What's the deal going forward to get them all firing?
So to a great extent, it's the same thing. Keep saying it. It's and I'll pivot off this for a moment, but I'll start off by saying it's a function of the market. So you look at the nature of the businesses that are, it's still a high interest rate environment, which means NIMs are compressed. So with net interest margins compressed, the pure banking side continues to be challenged for growth.
Right.
The same thing we talk about the equities market, the trading markets. It hasn't been a very active capital market. And as capital markets aren't as active, that's a big part of our business. Yeah. And that's been there. Now, having said that, I said the pivot is we are, on the one hand, we exist in our environment. On the other side, we drive our environment.
Right.
And so our intention is to actually drive these segments forward, where the changes in what we do. So we intend to create, be a proponent of growth. We intend to bring back the equities market, be a driver of capital. We want to see businesses grow, and when businesses grow, they need more capital. Yeah. So we want to help them, one, raise their aspirations. Second, help them raise the capital, work with you, us, others, but get more capital markets activity, which then creates a lot more supply of assets for our savings investors, right, who all need wealth management product, and that completes that cycle and that flywheel. So we want to drive that forward, and market conditions on slightly improving liquidity and declining interest rates, and that whole flywheel kicks in. But we're not sitting there passively is the point. Yeah. We actually want to be part of driving that forward.
Speaking of driving that forward, Angus, and I got a critique from a friend. I see that you have a IPO for Omni Manufacturing, yes. And I had a friend saying, why would they have an IPO out while the APO is out? And I said to them, look, at that Omni thing's going to sell off in one day, or I'll change my name. It's only $500 million, and only $121 million is available to the public. Yes. But talk to me about your pipeline of activities, to Rob's point. Sure. I mean, are you guys going to be doing a lot more IPOs, do you think, over the next 12 months?
I think I've been done very vocal, given our responsibility here in Jamaica. NCB Capital Markets is, very focused on revitalizing the domestic capital markets here in Jamaica, especially the equity capital markets. So the way we've structured NCB Capital Markets is one whereby we have a game, institutional willingness and support to operate at every layer of the capital stack, right? So that's private equity, public equity, quasi-equity, all the way to senior and mezzanine debt.
Right.
So what you would see is that those firms that need patient capital in the immediate, but prefer for a different environment to get better valuations. Value-wise, once we're aligned, you will see NCB Capital Markets use its muscle and provide private equity, prepare the firm to go public, and we have that patience and then go public, right? And in so doing, extract that value. So that is, part of our gameplay, so to speak. And Omni is a perfect example of that. We don't think the two offerings compete with each other. And, given who we are, we have no issues running 2 deals at the same time.
Good deal. And again, it opens on Friday. I don't need to advertise it. I know it's going to close on Friday. I'll change my name. Maybe it'll go to Monday, but it'll be done because it's only $121 million, I think, available to the public.
That is correct. Yes.
So this is a perfect example of you guys doing exactly what you said.
Yeah. So yes, we're long-term partners in the market. Once the values are aligned, etc. I'm not only talking about DCF values.
Right.
I'm talking about ethics, morals, vision. So that way.
Makes sense. Great. And I look forward to collaborating more with you guys in the future. I mean, you guys really are a strength to be reckoned with. Congrats on the results, Angus, Rob. I want to have you back next quarter. I don't want this to be a one-off thing because we want to see that the results continue to soar. And with that, folks, we'll be bringing today's discussions to an end. I'd like to thank our viewers, as usual, for always tuning in. Your support is appreciated. Big thanks to Rob and Angus for being here and being a part of the show 2 weeks in a row. Appreciate it,
very
guys.
much.
Thanks for having us.
And folks, if you're curious about future updates on our Virtual Investor Forum, then find us on social media. We share our live stream dates and our upcoming guests on our social media pages. So give us a follow to learn about all things forum related. As usual, don't forget to subscribe to our YouTube channel, Mayberry Investments Limited, and click the bell to receive all notifications. Well, remember, wise investors, slow and steady wins the race. Keep safe. Bye-bye.
Opening an investment account on GoIPO is easier than before. Using your NCB online credentials, simply log on to goipo.jncb.com to provide the required information. Our digital biometric identity verification system will confirm your ID instantly, so your account will be opened in minutes. Plus, now you can open your investment account with up to 3 joint account holders. So build your wealth and experience life with NCB Capital Markets.